Hello traders out there in Traderland, D7 here with GrokTrade, and I'm not doing a video this time. Let's see if it makes any difference at all. You guys don't need to see my ugly mug, so let's just get after it. Okay, first thing I'm gonna do is teach you guys. That's what we do very well as mentors. And first thing I'm gonna do is show you the inverted bond yield inversion. It's the bond yield inversion between the 2-year and the 10-year bond yields. Now, what are we looking at on this chart? This orange line is the S&P 500. This is the spider, or the S&P 500 index, going up, 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 up. We're just going sky high here. Same time, you'll see this blue line. This is the 2-year versus the 10-year. In other words, if you hold a bond 10 years, it should pay you more yield, more profit than if you hold one 2 years. 2 years should pay you less. However, every once in a blue moon, you will see one that will pay you less on a 10-year and more on a 2-year bond. Anytime that happens, that's an inversion. How do you look at it down here? This is the zero line. Do you see the zero line? The zero line coming across here, you'll see this blue line. This blue line, anytime it dips lower than the red line, you get this sizable drop. So if you look at this drop, this is the 2000 technology bubble pop. That dropped around 45%. Down, 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 down. It dipped. When it corrected itself, it went back above the zero line. That's when we had a sizable drop. Same thing happened here going into 2007, 2008 Great Recession. That happened when it corrected itself. We had a 65% pullback, really nasty. And then, lo and behold, right before the Corona crash, we did dip slightly below, just ever so slightly, and then we get one of the biggest crashes as far as velocity is concerned, the biggest we have seen since the Great Depression, only missing it by 3 days. That was a sizable correction in the markets. Now what we're in at this very moment, guys, is we're in the deepest and the longest inversion we have ever seen. 100% of the times, anytime that has happened in the past, we've always gone into a major recession. Not only that, double digit, I'll slow down, double digit jobless levels. Okay, so unemployment. We go into double digit unemployment rates, right? That is no good. That says we're deep into recession when that happens. The big question that we're looking at here is we're in the longest and the deepest we have ever seen, and look how we're up here building a bull flag like it's getting ready to correct itself. If that happens, we'll have a vertical red line come in, and usually what happens is a sizable market drop when and if that happens. Now, I'm going to show you another one. I'm going to educate you on another one. Now, I'm going to my personal LinkedIn page. I know I go by D7, but now you're getting an inside look. That's who I am. Feel free to, let's be friends. We can connect on LinkedIn. But I'm going to read you what I wrote here. Recession indicator alert that the U.S. unemployment rate ticked up to 4.1 this past June 2024, okay? Edging close to it, triggering the Sahm Rule. Now, that's a reliable recession predictor. If the 3-month moving average of unemployment rises by 0.5% from its low in the past year, okay, that's the key point here. A recession typically follows. Now, this is made by Claudia Sahm, the rule's creator. She says that she warns that the rising unemployment can start a negative feedback loop leading to recession. And despite the pandemic disruptions, the Psalm suggests that the Fed's reluctance to cut rates might push us into a recession. Optimistically, Wall Street highlights that AI and also the infrastructure spending that's taking place going into an election year, guys, is fueling the economic resilience. So in other words, what's being said is AI, along with us just putting a bunch of money in infrastructure spending, is keeping this market bolstered and going higher. But if you look at this, how do you read this chart? You can see this here. 0.3 is where we're at this moment. But anytime we tick higher than this line, you go into a major recession. This was the Corona crash. This was the Great Recession. This was the technology bust. And those of us who are older can remember some of these other ones. But some of us has been trading 20 plus years. We remember the Great Recession, and we remember even the technology bubble pop. So there's your education, okay? So we have two major economic indicators suggesting that a recession is on the brink. So if President Trump comes back into office, he's going to have his hands full dealing with this recession, because it's going to be hard not to go into that. All right, now let's take a look at the markets as a whole. What we're looking at here is a weekly chart, and I have a line chart up. You'll see the centered oscillator. This is a MACD right here, and then the RSI. Anything above this purple band means it's overbought. So at this moment, S&P on the weekly chart is overbought. We're making higher swing highs here, and we're almost ready to make a lower swing high. Now, this hasn't dropped yet, so we don't have that quite yet. But that would be very bearish if and when that happens. The MACD, same way. We're making higher swing highs here. Red line, you can see the red line going up, but the red line is going down here. Lower swing highs on the MACD. In other words, bearish divergences on the big weekly charts. Now, we go higher, higher, higher. And one thing I want to show you, when we go higher, 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 I'm going to just go just to the chart and volume. Look at the 20-week moving average on the volume. See how it's going lower, 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 lower compared to where it's been? Sizable lower. That means price is going higher and volume getting lower. That is a bad sign. Now, whenever we see volume start spiking higher, we get huge spikes. And for many weeks in a row, when we get that, that'll be capitulation. That will be the high being put in, okay? The high. So is this the high? Everything is pointing to it could be building one soon. Well, how do we know that? We have these divergences taking place. But we don't have the huge volume, capitulation volume. The inverse indicator, the inverse bond yield inversion indicator has not triggered where it hasn't healed itself yet. And the Sahm Rule, that indicator hasn't triggered yet. It's in the process of doing so. When all those happen, you can bet your bottom dollar that the high is in, and we will now start the descent in the marketplace. A good leading indicator, guys, is when you watch the Dow and you see that the Dow drops by 1,000 plus points in a single day. Or if it drops more than that and they shut down the markets due to the selling. If and when that happens, that will be a telltale sign that smart money is starting to dump their positions to get out of the market. That is a great thing to be watching. Now we're licking our chops here at GrokTrade. Here at Grok, we see this as a grand opportunity to start making a lot of money. Why? The people, the stocks will take the stairs up and they will jump out of the window on the way down. It will take forever to walk up. Like we're up many years right now, and it will only go down a year and a half, at the most 2 years. And so you got to make that money quick. You can't be bashful. You just have to jump in short and ride that train down fast and furious. But remember, man, you are cooking with gas at that moment, and you got to have a game plan on when to exit, because when the markets rally back, that could be a huge response, to the bull side, and it can rip your face off as a bear. So you got to be careful of that. We're not even close to those times. What I'm talking about is these highs being put in, and that is where we're at. Now, if I go here to the diamonds, quickly looking at the weekly chart again on a line chart, big rising wedge, we broke down. Now it's acting as resistance. We're barely above the moving averages, volume drying up, but this looks exponentially weaker than what we saw in the spider. If you go to the Qs are doing the best. Why? AI, my friends. AI is the let's go group. I mean, this is a sector that is on fire. We're at resistance. We're at this resistance, just poking our head over that resistance, making a higher swing highs. If you do this, lower swing highs is kind of in the making right now. And the RSI also, if it does start to drop here, that will be a negative bearish SI. So relative strength, we are overbought at this moment. And if you go to the Russell 2000, Russell 2000 is not nearly as bullish as what we're seeing in the spider and the Qs. Look at this, down, 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 and it's barely holding up, and it's starting to break that trend line right now. You can see it's breaking on weakening volume. Guys, if the Russell small cap starts to take a nosedive, it's already relatively weaker. That is bad news. We're below these moving averages. See that? Moving averages acting as resistance, not support. But the financials, what's the financials doing? If you look at this, we had this symmetrical triangle. It broke out to the upside. That's what gave the last couple of weeks a huge bump to the upside. There it is. Support. We didn't even hit support. So bullish, of course it was going to break out. Sure enough, broke out, boom, to the upside. It's starting to pull back a little bit here. The question is, will this become a bearish death hook? And what does that mean? It goes up, immediately comes back down into the apex of this symmetrical triangle. If that were to occur, look for the markets to bleed out, and that will set this motion into this market into a recession. So that's something that we're paying very close attention to right now. It's bullish as long as it stays above these moving averages. This is XLF ETF, biggest ETF out there for the banks, period. And as long as this stays above the moving averages and keeps giving us higher swing highs, higher swing lows, all is well in the markets, nothing to freak out about. But if this thing were to do an about face, come back crashing down below these trend lines, that's your bearish death hook chart formation. Look that up on Google, and that will give you more information on what the bullish and bearish death hook chart patterns look like. That will help you. US dollar, if you look at this, huge symmetrical triangle. It came crashing down the last few weeks, man, and we're at major support right now. The question is, what will it do on this support? I think there's a good chance of bouncing. If this goes higher, that's gonna play havoc on precious metals, gold, silver, and others, and along with stocks. And speaking of gold and silver, if you look at this, we had a big run, big pop, big triangle, boom, to the upside. But if the US dollar gets strong, look for that to start pulling back. Silver, same thing, big bull flag. We talked about that in the last video. Boom, to the upside. There it is. US dollar gets strong. Guess what's going to happen? It's going to pull back, so be watching that. VIX, there is no fear, guys. We still stay below 13. Fear needs for us to go into a recessionary pullback. Fear needs to get up into the 20 areas. We're just not there yet. 15 plus, ticking higher and staying up there. We're not seeing that on the fear. Now, this will literally be the last video you will probably ever see of me. If you don't subscribe, highly recommend that you do subscribe. If I've earned it, give me a like. It doesn't cost you anything to give me a quick thumbs up. You're not out one thing by saying like. So do me a favor, do that. The more you do, the better it is for the algorithms and others to see the video. I hope this was educational. Watch the first part of it again, understand those economic indicators and see how you can learn from those and what you can benefit from, and how you might be able to be watching this on a more interesting basis. If you want to watch my stuff on LinkedIn, feel free to go to LinkedIn, find me and watch me. I post some of this stuff on here that I see, such as this economic stuff, that will be highly beneficial to you, valuable to you as an investor in the market. So with that said, thank you very much, and we will catch you guys later. Guys, why are you still here? You just watched my video and now you're still lingering around. Might as well be with you now that I have your undivided attention. Listen, if you haven't done so yet, I highly recommend putting in a foundation of trading, your foundation of trading through a mentor. For learning to fly a plane, you wouldn't just go through ground school before you start flying in the friendly skies. What you would be doing, though, is going up first with your flight instructor. Same thing if you're going to learn to ride a bike, you better have somebody behind you helping you ride a bike. Surgery, you're not going to read a few books and do heart surgery. So every principle and with being guided by a mentor, let finances be this. If you are a trader, you rate you from amateurs to professionals. Mentoring will do that for you. Anyway.